What's up, Denver? Welcome back to an episode. Chris Lopez here. I got my buddy Terrance Doyle in the studio, and we're going to be talking about two things this podcast. What is going on in the marketplace? Because we got some uncertain times, and uncertain time changes people's mindsets, but also creates some opportunity. And as we talk about that, we're going to weave in a really great apartment building that Terrance bought during the height of COVID last year, recently just closed. So great case study about how you can still find amazing deals, amazing returns during uncertain times. Terrance, man, glad to have you here.
Yeah, it's great to be back. Feels like we haven't done this in a while. So yeah, excited to be here and in the new studio and to talk real estate. I feel like the world has completely changed since the last time we had a podcast. So I think it'll be good to have an update and talk about the market, talk about real estate, and talk about what you're seeing.
Yeah, I mean, like we were talking the last 90 days or 120 days now, man. It's the world has changed a little bit. And as we were kind of bantering before we hit record, you know, you've been hitting on message of three things with your team at VareCo. And I think actually a great thing to talk about, like, hey, the three things that you're focusing on, the mindset you got your team on over there doing, and then we can start weaving in like this really cool deal you put together.
Yeah. So, you know, we recently closed on, we sold formerly known as Timber Ridge, called Midtown Plaza. And, you know, it was basically just a group of local investors and I. And, you and I were talking about the genesis of the deal. You know, I found the deal in like July. I first discovered the deal in like July of 2020. So if you rewind what was going on in the world, July 2020, like it was very difficult. A lot of uncertainty, a lot of fear. You know, COVID was still like raging, a new thing people didn't know. You know,
horrible time to get debt for commercial properties.
It was super difficult, right? There was a ton of unknown, a lot of fear, and you know, debt was difficult. Raising equity was difficult. I mean, on this deal, you know, we had multiple people back out. You know, from the time that we put it under contract to the time that we closed. You know, there was like a 3 or 4 month gap there of getting the debt and doing the environmental and all the testing because things were slower due to COVID, harder to get into units, things like that. And so, yeah, I mean, looking back on that time, it's kind of similar to how it feels like today. Like investor sentiment is a little shaky. I think there is some fear and, you know, just a lot of unknown, right? Putting COVID aside, right? The world we live in today and what's happened since February and March of 2022, right? So 2 years later is, you know, we're at war in Ukraine. You know, we're back in Ukraine. We haven't been at war since the early 90s, right? So that's been 30 years. You have, you know, massive inflation that we haven't seen since the early 80s. So that's been like 40 years since we've seen this kind of inflation. And then the last one is, you know, we've had mortgage rates, residential mortgage rates go from like 3 to 3.25 to like 6.5 in like a 4-month span. So any one of those individually would rock the economy or have a pretty big impact, but you have 3 of those things colliding all at the same time. And so what that has done, and, you know, we work with some pretty sophisticated investors that have, you know, run billion-dollar hedge funds and private equity and, you know, really, really sophisticated people that have seen a lot of different trends. And they've all said, we've never seen anything like this. And, you know, the way they've described it is just the Fed trying to thread the needle, you know what I mean? In terms of what they're trying to do with raising interest rates to offset inflation. And so it kind of feels like the same thing. Like, even though we've had like a lot of great exits and we've had a lot of momentum, you know, the time we sit today reminds me of like where I was in June, July, and August of 2020, where a lot of uncertainty, a lot of fear. Some lenders are like, we're not lending at all. I don't know if you remember that, but like,
I remember
early
that.
on in COVID, like lenders were like, we're not even lending. Like we're not lending. Like, you know, we're working from home, no lending. And lenders aren't being that direct today, but they're definitely like widening their spread, being much more conservative on loan to value, on the appraisals. Just everybody has kind of tightened up and is basically saying, we're going to press the pause button. And, you know, so I think it's important to realize that, like, you know, we bought what I think, you know, in some of the best real estate, some of the best deals, risk adjusted basis that we bought in 2020, we're now selling those and doubling, tripling our money. And the only reason we were able to do that is because we stayed consistent and disciplined during what most people thought was a time of fear and to maybe press pause, right? And so I think the same thing for today, our mentality at VareCo has been, hey, just because the rest of the world is stopping or pausing or afraid doesn't mean we need to stop. It maybe mean we need to adjust some underwriting, be much more conservative on exits and cap rates and underwrite much higher interest rates. But it doesn't mean we should stop, because when other people get afraid, that's actually when you can get some of your best deals.
It's like the Warren Buffett quote.
The Warren Buffett quote. Yeah. When other people are afraid, be greedy. And when people are greedy, be afraid.
Yes.
Yes, that's it. It's the inverse, right? It's like whatever people are really bullish on something, maybe that's the time to be cautious. And when other people are being cautious or fearful, maybe that's the time to be a little bit more bullish. And so I just think it doesn't feel good to be looking at a screen watching CNBC and everything's red and the Dow's down 1,000 points. Like that doesn't feel good, but that actually means that's the time to buy Apple or Amazon, right? I mean, most really good investors, that's what they would say over time. And so that's what we're experiencing and seeing. And that's kind of our frame of mind going into, I think, this period of uncertainty. And, people are throwing around the word recession. And yeah, I mean, I do think we're going into a period of time where people are going to have less liquidity. I mean, that's essentially what the Fed wants to do with raising interest rates and all of the fiscal policies that they're putting in place, is really just to take liquidity out of the market, and that's their answer to inflation. That's what they think the answer is. And so whenever that happens, right, there's going to be a major shakeup. Like a lot of my buddies that are residential or commercial lenders, I mean, their business has been cut in half or more than half, right? I mean, I have buddies that used to do 30 loans a month and now they're doing 5. So and that's going on across the board, right? Residential real estate is really, really, coming to a stop. And I think commercial real estate is much slower than it was. And it really, in a short amount of time, has become a buyer's market where sellers aren't really dictating terms anymore. And, so for us, and in my personal opinion, now's a great time to be proactive and to be looking and to be diligent and intentional about, I think hitting the streets and talking to as many brokers and just being ready. We've done so many podcasts on what does it take to be ready to buy, right? Be pre-approved, have the cash, have the lenders, know who's lending right now. One of the things that I've been spending a lot of time on is, hey, who's looking to be aggressive investing, and what lenders are looking to still be active, because we're going to be active, because we're going to, we believe that we're going to be seeing on a risk-adjusted basis, some really, really good opportunities in the markets that we're in. And so, I just think high level, that's something good. As we talk about Midtown Plaza and you go back to what was going on in the world, it's not too dissimilar to what's going on now.
Yeah, it's times of uncertainty. It's a frothy market. And back then, in some instances, it was probably way tougher because a lot of people, hit pause on the world for 2-3 months. Right. And I remember as you were raising money for that deal, you had a lot of people kind of hemming and hawing or, backing out last minute. So it was tough to put together, but you stuck to the fundamentals, you underwrote a good deal, and, the team executed. And we were able to execute, yeah. So give us a high level. Like, you got the deal almost, actually, a little less than 2 years ago, July of 2020. And I know it was a motivated seller, but there was a lot of negotiating back and forth all around. Like, just paint us a picture of what's going on and how you got it.
Yeah, so the owner had owned it for 30 plus years. There was a lot of deferred maintenance. She was she cared a lot about the property, just didn't have the capital to reinvest as time went on to upkeep. And so she had a lot of VA tenants. So like the federal government was paying veterans to stay there, and they had lost their voucher because they had failed 3 inspections in a row. There were some units that didn't have hot water, some units that didn't have heat. There was holes in the roof. When we went to look at the property, I mean, there was just needles everywhere, drugs. I mean, you would think this was like in a war zone. And it was in a really,
this is North
Denver, across the street from like brand new construction, brand new homes being built by KB Homes, like $600,000, $700,000, $800,000 homes, like literally 2-3 blocks. So not in a bad area, but just had been mismanaged, run down. And so she was very motivated because she was quickly losing cash flow and getting to be, negative cash flow to cover the debt service. And so when I saw the property, let's say in July of 2020, I knew immediately it was a deal. We just had to get to the right terms. And so we went under contract at a price. And then after we did the inspection, realized like, hey, this is mold. I think there was roaches. I mean, just everything you could imagine was sewer issues. And so we were able to get a pretty good concession. I think it was close to $400,000. And, at the time, Brandon Kaufman was under a different flag, but he worked extremely hard. And so one of the fundamentals is having brokers that are experienced. I mean, I think when you're going into a season of uncertainty, having brokers that are experienced, know the market, are very confident, and can sit in front of a seller that's motivated and say, listen, seller, this is what's going to be needed if you want to sell. I've been through this many deals. I've seen it this many times. If you want to sell, this is what's needed. And so he did a really good job controlling the deal, controlling the seller, and getting us to the closing. So we closed in late November of 2020, and we started construction. And we had issues all the way, with some residents didn't want to leave, and we had to do evictions. And again, like evictions were super hard. And so, every single thing was difficult. getting materials was difficult, the whole thing. And, we finished construction in September of 2021.
Okay.
The world looked a lot different then. And so we were able to start renting units for $200 to $300 above pro forma. So we had underwrote very conservative rents as if COVID was going to continue for 2 or 3 years and it was going to be very difficult to rent. And so we underwrote rents very conservatively. I believe it was like $1,050 for 1 bedrooms. We ended up renting them for between 13 and a quarter and 13.75.
Because this was all 1 bedrooms and 2 bedrooms, right?
1 bedrooms and a few 2 bedrooms.
Okay.
Right. And then we were able to add a unit. They had a maintenance room that was like 600 square feet. We turned into a unit. So we took it from 40 to 41 units, and we took, pro forma rents from like, let's say 1,100 to 1350 blended. Some of the 2 bedrooms were 1650 and some of the ones were a little higher, but blended, let's just call it 1350. And our property management team, Live Lavender, was able to do an incredible job. I believe we had the entire thing leased in like 10 weeks. So to lease 40 units in 10 weeks is like unheard of. The average is more like 8 a month. 2 a week, and
but you guys did some really creative stuff, because I remember I think the tail end of leasing it, we went to go record one of the Bigger Pockets walkthroughs, and you guys had, I don't know, a 15-foot banner on the side of the building, giant QR code, a good website, really good like marketing video, drone video. I think you had a lot of the residents out there and some team members out there, in the common space, and it was just a really well done thing, which you typically don't see for, a Class B apartment.
Class B property,
it looked great, and you always do great finishes, but in the day, it's still, a 1960s, whatever it was, product. But it got marketed as a Class A product, which, I'm sure helped get people in the door.
Yeah, I think some of the nuance we've learned, for sure has helped. I think some of the systems and process we implement on construction allow us to do things cheaper and faster than the market at scale. And then I think on the property management side, we definitely know how to market properties. We know how to screen tenants quickly. We know how to get the right people in, and we know, we understand how to do rent studies. And so just the fundamentals of leasing is like, how do you get the most views? How do you get the most showings? How do you convert those showings? How do you get the right people in? How do you screen them? And then how do you make sure that every single thing works? In apartments, the number one thing for people to leave and not renew is, my stove doesn't work or AC wasn't working or this. It's like, how do we get everything to work? And, our team does an incredible job. Daniel, my brother, oversees Live Lavender, but, the people that we have on the ground, Jordan, Brittany, Zach LaRue, have done an incredible job in terms of like the leasing, the management. Zach Spicer did an incredible job overseeing, the construction. And, I'm super humbled and thankful. We have a really great team of people that really care and that want to get things done. They want to get things done. They're highly motivated, and we've found good ways to align interest, with VareCo and our investors and things like that. So, and so we finished leasing. We had grown the NOI, and initially we underwrote that the exit was going to be like $6.5 million. We bought it for 4.4. We're going to put $1 million in, exit for 6.5. That was going to be a really great return. And
what was the whole time you had planned?
3 years.
Okay.
I think we conservatively underwrote 3 years. And, so with the current NOI and the market where it was, Brandon and his team at KH gave us guidance that they thought they could trade it somewhere between 8.5 and 8.8. And they're like, let's go to market at 8.8. And they did an incredible job with, the marketing plan. I think we had, thousands and thousands of views online. We had, something like 30 or 40 showings, which I've never seen. And, multiple offers. I think we had over 10 offers emailed to us. And then we had 5 offers over asking, and then 2 offers over 9 million. And then, they were, the brokers were able to get the buyer that we ended up going with to 9.1. They put some earnest money that was non-refundable, and we were able to close it. And let's say we went under contract the second week of February. We closed, I believe, like the first or second week of April, something like that.
Yeah.
It was in April, and it was amazing. It was a great, I think, model for VareCo, for Live Lavender, for KH, and everyone involved, and then our investors. They got the gross MOIC was over 3. The net to investors like 2.1 times your money in like 16 to 18 months, something like that. I can't remember the exact
if someone put $100, they got like 200 and change back.
Yeah, in a short amount of time. And so just on a risk adjusted basis, it felt really, really good. And so that was great. We've got a couple other properties under contract to sell, and it will be, really good returns. But to date, that's been the highest gross MOIC and net MOIC that we've been able to return, to our investors. And yeah, it was amazing. And I think just going back to, the fundamentals of how we underwrote, the principles of just when everyone else was afraid in the market and people were like, oh, we're not buying, and lenders were like, we're not lending, we're able to get very proactive. And, one of the carrots on this deal that we didn't mention was that Brandon had a lender in his pocket that was like, we will lend to certain buyers if they're established, have a track record, and have a certain amount of liquidity. And we hit those boxes, and we were able to get insane terms on this deal. Really, really great terms. And so that was one thing is, like when you're going into uncertainty, having brokers that know the market and have lenders that are willing to lend allowed us to do this. Because First Bank was like, we're not going to lend. They were willing to lend at like 50% of purchase or something, like terms that wouldn't even make the deal work or pencil. And so having brokers that know the market, have the lenders that are willing to be active is a really, really big advantage. And that was a huge key to us getting this.
What were the rough terms on the loan? Do you remember? Just like high level?
I think we got 80% of total cost. We got it at 3.5% fixed for 5 years. We had IO through construction and 30-year AM. And the origination was pretty reasonable.
Great terms for back then.
Yeah, no, it was really good, especially during the COVID. I mean, to get those terms at that time, especially on a deal that did not pencil and had, 10 people living in it, like it was 25% occupied. I mean, no one was really looking to touch that kind of deal.
But that goes to show, like you said, like, as you build out your team, work with, high caliber people, they're caliber people, especially people like Brandon, they know the right people, they know the right song and dance to keep the deal together and bring in this person. Hey, you need a reality check over here, Mr. Seller, Mr. Buyer. Here's where we can meet in the middle.
Yeah.
I want to go back because I remember the marketing one for what Kaufman Hagen did for this was a lot of fun because it was like the first big digital blitz we did for the marketing. Yeah. And we spent a good chunk of money on there, but it was like we got like 200,000 plus views on ads and a bunch of people like saying like, why do I keep seeing that on Google or Facebook? Like, hell yeah, that's what we want to hear. And I know, hey, same thing you talked about for like taking prospective tenants through the process of, eyeballs on their property, get them in for a phone call, get them for a showing. It's the same thing for marketing properties. The more eyeballs you have on there, the more interest, the more inbound inquiries, the more offers, the more that you can then, work prices against each other, the better terms you can get and carry it to the finish line. That was a really fun marketing campaign.
Yeah, no, the team crushed it. I mean, I remember we sat down together and we were like, hey, look, there's still uncertainty, this is a price per door that hasn't been done in this area of Denver. And, how are we going to get the maximum exposure and the most number of people through there, the most number of qualified offers to get the best deal? And so, I thought Brandon and your entire team over there did an incredible job of the marketing. Brandon and Teal did a great job executing and negotiating it. And just the whole thing from start to finish was really well executed. And that's really what it takes, I think, especially going into economic uncertainty or a recession or whatever you want to call it. Like you have to have a team of people that are, that you're working together. You have a game plan. You have you can execute it. And that's really where the advantage comes. And I think that's where our advantage has been is, in a really competitive market, Denver or Des Moines, like there's always people looking, right? But when you have like systems and process, you have a track record, you have the platform that has done this kind of thing multiple times, I think that is where we're able to really have an edge and to deliver the kind of returns that we expect to deliver, right? So we're really excited, we're super humbled and excited and really thankful for the people that believed in us, right? Because writing that check and sending that wire and committing to that in July, August, September, October of 2020 was not a really comfortable thing for a lot of people,
No.
And, a lot of stock prices had gotten crushed, maybe then at that point they were on the way up, but it still was not like, hey, that we're going to go into this bull run like we did. And no one could have predicted, what was going to happen. And so, it was for me, it was a great learning lesson. We had, like you said, a bunch of people back out, a bunch of people say no, we're scared. I had one investor that was maybe at the time one of our biggest investors basically be like, if you buy this deal, I'm not investing with you ever again. Like, I think you shouldn't be investing. I think the world is in a really...
is that
yeah. And he was like worth tons of money and had written really big checks. I think his average check size was probably like $1 million in deals. And he was like, I want to back you on every deal, $1 million. And then when COVID happened, he was like, I think you should stop. I don't think you should be doing anything. I think you should wait. I think it's getting really... And I was like, sir, I can't do that. You know what I mean? Like we built a company to like buy deals, not to sit on the side. Like when we see a deal, we need to execute. And he was like, if you do this deal, I just don't think I can invest with VareCo anymore. And he hasn't, since. And so, there were really tough conversations that happened. And, it was a really, interesting time for me personally, because, I just started VareCo and we were not profitable and we hadn't really had a track record. And to have people, that were big investors at the time saying, hey, we don't think you should be buying, was difficult. But, I just think, at my core, when I started buying in 2008, right? At my core is I just know how to buy deals when there's motivated sellers and when I feel like it's a discount and when the season is right. And whenever there's fear, I think that is when, a light bulb goes on and says, hey, this is where we should be really, I think more proactive and more intentional and, just being disciplined, but being in the market, and letting brokers know, hey, we're definitely buying, but it needs to be right. And I think what people don't realize is when the market is hot and everyone's like, buy multifamily, it's a much harder for us to do deals, to get deals that make sense, right? And way, way harder to dictate terms and say, we need it at this price and we need blah, blah, blah. But when there's fewer buyers and everyone is scared, we can dictate terms and say, we need it at this number and we want to close on this day and we need the rent roll, we need to take over management or whatever the terms are, and we've even seen that in the last 30, 60 days is we're getting to dictate terms more than we have in the last 2 years.
So I got two questions for you here. So first is, great summer and all that stuff. Now going forward, we're going to summer 2022 right now, and we all know the problems going on. Mm-hmm. What's kind of the strategy now, the aggressiveness? Sounds like you guys are full steam ahead. And has your strategy changed or still just your classic value add and you're now able to dictate terms better?
So I do think the strategy is pivoting, from buying like dilapidated buildings that have maybe half of a rent roll or, is, half vacant. We are going to be looking to buy more blue chip type properties. So I think location, going into a recession, and a recession to me really just means people could be losing their jobs, right? Companies could be laying off. I mean, you've seen Tesla, JP Morgan, all these big names are saying hurricane, tsunami, we're going to be laying off 10, 15% of the workforce. Like that's going to happen most likely.
Yep.
When people start saying that, it's going to become a reality. So, when you think about and we're in the workforce housing game, people getting laid off. So we need to be really, really focused on location. Like I think location matters now more. And then your basis, your cost basis matters a lot, right? What your basis is because debt has gone up. And so being able to service that debt, and be able to make a distribution and be cash flow positive. So location really matters. And I think your basis, so being really price sensitive.
So in terms of location, just higher.
Yeah, so I'll give you some examples.
Yeah.
So in Denver, so like Cherry Creek. So I would be buying Cherry Creek. I think if you own a building in Cherry Creek or a home that you're renting, I think that a lot of bad things can happen in the market and you're still going to be able to rent it and really close to your pro forma. Mm-hmm. Like Cherry Creek, Wash Park, right? Sloan's Lake. I think there's parts of like Inglewood in the suburbs. I really love the suburbs. I think the suburbs are less price sensitive and are, dual income and things like that. So, and I also think you can buy it for much cheaper on a risk adjusted cost basis. And so I think certain parts of like Inglewood, Arvada, Wheat Ridge, Lakewood, Littleton, a deal we just did in Lakewood, Lakewood put a moratorium on building. So if you're buying apartments or houses in Lakewood, there's a good chance that supply and demand is in your favor, right? There's not going to be that much supply. Demand is only increasing because one of the things you have to think about is if it's harder to buy a home and there's less buyers for homes, there's going to be more renters, more qualified renters. And so buying in specific locations means you're going to have more demand, even though there could be some people getting laid off. There's still, pro rata, around the in the metro, there's going to be more people looking to rent.
And that's one of the reasons too, multifamily in commercial assets has stayed so hot and attractive in the last few months because rents are rising.
Right.
And as interest rates go up, that's bumping out, probably 20 to 30% of the buyer pool to buy their first time house. Yeah. So that just forces more people back into being renters.
Totally.
Which is unfortunate for them, but good for apartment owners.
On the inflation point, one of the other things that people don't realize is that, if you own an industrial building or office building or retail or restaurant or anything else like hospitality, rents don't reset for 2, 3, 4, or 5 years. Like when you sign a lease with a commercial tenant or an industrial tenant or an office tenant, you're most of the time locked into that rate 3, 4, 5 years and maybe 1 or 2% bumps.
Yeah, that's predetermined bumps every
3 or 4 or 5 years. And so the great thing about the apartment business is that you can reset rents every 6 to 12 months. So as inflation continues to go up and there continues to be less and less people buying homes and more renters, you can capture some of that with the new rent, with the new lease. And so that's been one of the things that I think has really helped multifamily, but not a lot of people talk about that aspect of how inflation actually can help if you're in the multifamily or even single family game. So
what about, I gotta ask a question, because I've had this just debate a lot of times with people rents have gone up like crazy, just like prices have, the last couple of years. is there going to be a ceiling of how much people can raise rents? Because I mean, eventually, especially with inflation, like renters will get squeezed at some point. Like they are well, I'm curious, like when that ceiling happens or if that happens.
And I think that's where going back to locations and your cost bases really, really matter. Like I think you have to be very disciplined in, I'm going to buy in these micro neighborhoods, and this is where my price per door needs to be, depending on how much construction I have to do. Because yes, absolutely. Like you can't raise rents to infinity. And, we really see a cap on 2 bedrooms somewhere around 1,500, depending on the location, right, in the neighborhood. And so that's why, we're buying buildings where the average rent is 1,000 or 1,100 because we know we can get it to 1,500 really, really conservatively. Now, can I get it to 17? I don't know. Can I do what I just did in the Highlands or in other neighborhoods where we've, have rents at 16, 17, 1,800 and we have a waiting list? I don't know that we're not underwriting that, for sure. Like I'm not going to bet on that. Maybe that'll happen, but I'm not forecasting that. But I think 1,500 for a 2-bedroom that's like renovated and clean, I think is down the middle of the fairway, very conservative. And I think is actually low, in terms of what we're seeing in the market. So I just think being very focused on location, where like, even if the sky falls and things get really bad, like this is a location people are going to want to live and going to need to live, and a basis that's really, really conservative, right? I think speculating on appreciation is dangerous, but forced appreciation through construction and good property management, I think is totally fair, and I think is appropriate, right? I mean, at some point, you need to have like a healthy standard of a conservative versus aggressive. And so I think that we would call that like, very fair and risk adjusted underwriting. So that's kind of what we're looking at is, we're very specific on locations, very specific on the basis that we're going to buy into, and just less heavy construction. I want to do more like lipstick, more painting, floors, cleaning, versus like heavy value add like we just did at Midtown, because going into recession, like I want to keep the basis as low as possible. Spending more and more on construction, increasing the basis is not really what I want to do. I'd rather lower my rent comps and pro forma on rents and lower what I'm going to spend on construction. And then look, if the market continues to take off and debt comes back down and cap rates compress, then look, my basis is low and we win. But if cap rates expand and, and debt continues to grow in terms of interest rate, and there's fewer and fewer buyers, I don't want to be stuck in a property that I can't sell for a profit. And so just keeping your basis low, I think, is key. Whether you're buying a single family home as a rental or a multifamily property, I think that would be my advice. And that's the way we're looking at deals. And that's kind of our fundamentals currently at VareCo.
All right. Second question here for you, because I've gotten this question a few times now as we've done some podcasts and I've seen people watching social media. I've had people ask me about your property management company, Live Lavender, and they asked, does Terrance's Live Lavender manage other people's properties? What's your answer to that?
No, not right now. We tried to do third-party construction, and we've done it for 3 or 4 key investors, and it's gone well for a few, and on other ones, it's hard because our main priority at VareCo is to manage our own properties, construction and property. And that's the number one thing. Like our fiduciary responsibilities to our investors, and honestly, like me being one of the bigger investors, it's like we need to execute on the VareCo projects. And so it's been kind of hard because it's felt like we were serving like 2 masters a little bit. And so we're no longer going to be doing third-party construction. We will do third-party property management only if we own the building and we're selling it. So like on a couple of buildings that we're selling, we would retain it because we know the building, we know the ins and outs.
Like Midtown, for example.
Like Midtown, West 32nd, any deals that we're selling that we've renovated and we know intimately well, we would do. And then, I think down the road, we would look to grow that into like 100+ unit buildings for like institutional buyers. And I think that could be strategic for us, but not right now. I mean, I think right now we're really focused on the deals that we own and delivering the best return and really focusing on that. And then if we're selling a building and it's already fully leased and turnkey, like us retaining management only makes sense from the aspect that we know the residents. We already signed the leases. We know the maintenance. We know the building. We have.
You've done all the hard stuff.
We have the warranties for all the labor and the warranties for the materials, and so the buyer's actually getting, I think, well,
that's a big cherry on top. If I can maintain the property management, because that's one of the biggest keys. They're kind of getting a pass there, instead of having to transition it to someone else and teach them how the building works and who the resident. Because what you see is a lot of attrition when you pass off a building, like the residents want to deal with the leasing agent they sign the lease with and things like that. And so I do think that's a big carrot for us when we're selling a building. Like, hey, we'll stay on at a market rate. We already know the building. We know the people. And so we are in discussions to do that on some buildings we're selling right now in Denver and Des Moines. But just like Joe Schmo off the street in their fourplex, we're not doing that. And honestly, I don't think we really have an advantage
in that game. I think our advantage comes when there's scale. When there's 40, 50, 100 plus units, I think we know how to do that better than most just because of some of the fundamentals we discussed. Like we really understand leasing. We understand the rent comps. We really understand renewals. Like renewals is one of the things that we really focus on is how do you get people, once you've done all the heavy lifting of construction and leasing, how do you get them to stay? And maintenance, the systems and process around maintenance, so things like that. So yeah, Live Lavender, I'm really proud of the work that we've done over there. We've got an amazing team, and I do think we'll be able to add value to buildings that we're selling and those new owners and retaining management.
Dude, that makes a lot of sense. So Terrance, thanks a lot, man. I always appreciate sitting down with you for 30 minutes, talking deals, fun talking the market. We'll have to get back in the groove doing this more often. Last question for you. How can people get a hold of you? They want to know about what you're up to, deals, potential investment opportunities. What's the best place for them?
Yeah, we can put our website in the show notes, and then Instagram, LinkedIn. They can reach out to me, and my cell phone's online. People can shoot me a text. But we are going to be launching a coaching program here for people that want to grow their real estate business. It'll probably launch in August, and it's going to be we're going to have one aspect that's going to be rising stars. So like people just that want to learn and grow. And then another aspect is going to be called like the franchise player. So people that really want to like real estate full time, that are syndicating or flipping or doing anything at scale. And then with my background and experience, I'm able to help them scale their business, grow their business, really get into the nuances of how do you underwrite, how do you raise capital, what are some lenders that I have that'll lend to them, maybe some investors I can help introduce. And so we're going to have 2 programs. I'm really excited about it. I think I've been doing it with 3 groups right now that I've been helping them, and I've stepped in to help them get the debt and help them manage their buildings. And I've really enjoyed it. And I think it's kind of the next progression of the podcast of like, we know all these people around the country, and I've learned just firsthand from managing my own stuff and buying and lending and raising capital and even managing a team now, right, of 50 plus employees. It's like there's a steep learning curve to all of that. And so being able to pass that on to strategic people that we believe that could be like-minded and strategic partners long-term. So I think we're going to be having some really exciting things coming out later this summer and then the fall. And then we have season 3 of Multifamily Mentors. We're going to be working out with Bigger Pockets, and we have some awesome guests lined up for that.
Yeah, I've seen the waiting list.
Yeah,
it's another stack.
So we have a lot of really exciting things coming up, and so people can reach out. I think just through social media is probably the easiest thing.
Cool. Well, we'll definitely talk all about that stuff as it comes out. So stay tuned to the podcast. Follow Terrance on Instagram. I'd recommend going to VareCo, get on their email newsletter as well. I know you guys are pumping that up now and revamping. It's great. So definitely stay tuned. Listeners, thank you. Terrance, thank you. We'll see you guys next week.
This was great. Thanks, Chris.